And we know it's pretty much a done deal, but do you think we're going to see more of a dovish hike or perhaps more of a hawkish one?
So, I mean, I've been on 4 hikes for the year. I've been kind of the outlier from the beginning of the testimony. I think the market is skewed for the Fed to be dovish this week, the ECB to be hawkish, and I'm more the other way around, actually. With that said, Powell does have plenty of time to raise expectations for potentially making September live. So you'll have both a September and a December hike after this. But I think the risk is very much to the upside in rates in the
So
US.
If we do have these press conferences after every meeting, do you actually see that changing how markets are going to price in August and November? I mean,
absolutely. And you remember we just had the great risk off about 2 weeks ago when everyone was kind of running for the hills and buttoning down the hatchets. I mean, it was interesting to see you went from Fed rate expectations of 2 hikes being priced in to barely 1 being priced in. That's just how huge the variation has been. But if you look at the U.S. data, it's the only one that's been holding up. ISM's beat again very healthily, both manufacturing and non-manufacturing. We just had CPI overnight, core coming in at 2.1, headline coming in at 2.8. I mean, we're knocking at 3% here.
They can't reach a consensus on whether this 2% inflation can actually be sustained.
I think, from my perspective, I think global growth is robust. I think inflation is robust, and it is melting up at the end of the day. I don't think you can kind of deny that. There's definitely doves as well on the Fed's kind of side of things. But I think at the end of the day, they're really the only main central bank that's going to continue to hike.
Okay, I think one of the questions, of course, about inflation is how much that headline has been pushed up by oil prices. Lael Brainard, who is a very important Fed official now, an ally of Jay Powell's, recently said it's very important for the Fed to get inflation to 2%, but keep it there. Is it possible that that's the reason why the Fed will wait until September to tell us maybe they're going to do 2 more hikes, but for now, just wait and see if inflation stays at 2%, and not just the CPI, the all-important PCE and core PCE?
Well, I think, from a perspective of optionality as a central bank, you never want to paint yourself in a corner. It makes more sense for them to be prudent from that perspective. But again, going back to the initial testimony of Powell, his very first public speech, I mean, he was quite constructive, and he never really had to be. At the end of the day, you reverse, we had 3 dots, or should I say 3 hikes on the dot plot for 2018 from last year, which was pre the fiscal stimulus, i.e. the tax cuts that we kind of got through. So, he could easily err on the side of caution and wait to update the market later on. But for me, it's just a question of time before we move that way. I think the key risk comes if it is a dovish hike for some reason, and then we could see potentially an inversion in the market.
Yeah, actually, that is what I wanted to ask you about in terms of looking ahead to the possible flattening of the yield curve here. And 1, whether you believe it is a harbinger of a recession, and 2, when you might see that happen if the Fed does come across with a dovish tilt.
So I think on the second last point, I mean, statistically speaking, it seems to be one of the best indicators out there about going into a recession. But again, if you look at the leading indicators and growth generally, and China PMIs also beat, that's, I think, a non-issue in this case. I think, though, you look at the spread between the 10s and the 30-year bonds in the U.S., it's only about 15 basis points. So if the Fed were to come across as dovish for whatever reason, then why wouldn't investors back up the truck and, lift all the 30-year bonds? So you could actually see a case where the 30-year actually sinks lower than the 10 years, and I think that's a key risk that they have to also take into account.
What is the direction of yields now? I mean, we've seen the pretty strong bond auctions this week, especially with the 10-year. We saw bid to cover, 3-year averages and above that, but we still can't quite keep that sustainable 3% on the 10-year. Could the Fed change that?
Correct. I mean, we're knocking on it. We got to 312, then we went back to sub 180, and now we're kind of 296 this morning in Asia. I think we're going to pop back over 3%. I think it's only a matter of time. We're only going to make new highs. But the key level now is on the 30-year bond. 325 is really the key level for that to break on a sustainable basis.
Talking about the ECB then, why do you think more hawkish for them, less so when it comes to the Fed?
I think Draghi's got a fine line because, as we all know, September was supposed to be when the bond purchases stop. But also, as we all know, we have this little Italy issue in Europe, right, which is far from over. Yes, we seem, at least for now, yields have come back a lot lower in Italian bonds. For instance, the 2s are well back south of 2%, close to where they got. The 10s are back under 3%. I just think if he was to be very hawkish and say we're stopping the bond purchases and we're moving towards QT, then I don't think that necessarily sends the right signal to the peripherals. And Spain is also far from a done deal. I mean, we just also had an MP switch there, and that could still be a snap election, within the next kind of few months, depending on how things go over there.